Hello, everyone, and welcome back to International Financial Management. In today's session, we're going to explore one of the most important topics in global finance, exchange rate determination. By the end of this short lecture, you should understand how we measure exchange rate movements, how equilibrium exchange rates are determined, the key factors that drive them, how cross-exchange rates work, and how inflation, risk, interest rates, and even currency wars shape the value of money. Let's dive in. How do we measure exchange rate movements? At the simplest level, an exchange rate tells us how much of one currency you need to buy another. For example, if 1 US dollar equals 150 Japanese yen, that's the nominal exchange rate. But economists also look at the real exchange rate, which adjusts for inflation differences. Imagine the US has 5% inflation and Japan has only 1%. Even if the nominal rate stays the same, American goods become relatively more expensive, meaning the real value of the dollar has fallen. We also use the effective exchange rate, which is a weighted average against a basket of currencies. This is helpful because countries don't just trade with one partner, they trade globally. Finally, there are cross-exchange rates. For example, if the dollar trades at 0.90 euros and 150 yen, we can calculate that 1 euro is worth about 167 yen. Cross rates are especially useful when a direct market rate doesn't exist. So, how is the equilibrium exchange rate determined? Think of it just like any market. It's where supply and demand meet. If more people demand US dollars, say to buy American goods or invest in US stocks, the dollar appreciates. If the supply of dollars increases, say, Americans are importing more goods or investing abroad, the dollar depreciates. A good real-world example comes from the 1980s, when U.S. interest rates were very high. Investors around the world wanted to hold dollars, and that pushed the exchange rate up dramatically. Now let's look at the main factors that shape these movements. Inflation. Higher inflation makes a country's goods less competitive, so its currency tends to weaken. For example, in the 1970s, U.S. inflation led to a weaker dollar on the global stage. Interest rates. Higher real interest rates attract investors, strengthening the currency. For example, again, the U.S. in the early 1980s, tight monetary policy caused the dollar to soar. Economic growth. Strong growth can boost investor confidence and capital inflows, appreciating the currency. For example, China's rapid growth in the 2000s put upward pressure on the yuan, even though it was tightly managed. Risk and stability. Political instability, defaults, or wars scare investors away, causing depreciation. For example, Argentina's repeated financial crises led to massive drops in the peso. Balance of payments. Trade surpluses usually support currency strength, while deficits put downward pressure. For example, Japan's trade surpluses in the late 20th century supported a strong yen. Let's return quickly to cross-exchange rates. Imagine the British pound is worth $1.25 and the dollar is worth 150 yen. Multiplying those gives us a pound-yen rate of about 187.5. This calculation is vital for global corporations that operate across multiple currencies. It's also key for traders who look for arbitrage opportunities between markets. Inflation deserves special emphasis. High inflation erodes a currency's value both at home and abroad. Think of Zimbabwe in the late 2000s. Hyperinflation made its currency essentially worthless. Even in more stable economies like the US in the 1970s, high inflation weakened the dollar and forced policymakers to act. Next is the role of real interest rates. That's the nominal interest rate minus inflation. If a country offers high real returns, investors will flock to it. That pushes up demand for the currency. For example, in 2018, the US Federal Reserve raised rates while Europe kept them near zero. The dollar strengthened against the euro as investors shifted capital into U.S. bonds. If you'd like to explore this topic further, here are some excellent official resources. The International Monetary Fund, IMF, at imf.org for exchange rate research. The Bank for International Settlements, BIS, at bis.org for global FX market data. The World Bank at worldbank.org for economic trends. And the U.S. Federal Reserve at federalreserve.gov for U.S. monetary policy insights. Risk is another big factor. If a country faces political turmoil, investors usually move their money elsewhere, often to so-called safe haven currencies like the US dollar, the Swiss franc, or the Japanese yen. For example, during the European debt crisis around 2010, many investors pulled money out of countries like Greece and poured it into Germany, strengthening the euro in the north but destabilizing it overall. Finally, let's talk about something dramatic: currency wars. A currency war happens when countries intentionally devalue their currencies to make exports cheaper and imports more expensive, hoping to boost domestic growth. In the 1930s, during the Great Depression, many countries engaged in competitive devaluations. More recently, in the 2010s, there were accusations that countries like China, Japan, and even the US used monetary policy to weaken their currencies for trade advantages. While devaluation might provide short-term relief, it often sparks retaliation and instability in global markets. To wrap up, exchange rates are determined by a mix of fundamentals like inflation, interest rates, and growth, alongside perceptions of risk and government policies. They matter because they affect everything, from the price of your coffee imported from abroad, to the competitiveness of a multinational corporation, to the stability of entire economies. Understanding exchange rate determination gives you the tools to make sense of international finance and the forces that move our global economy. This concludes our discussion about exchange rate determination. See you at the next lecture.